Hey everyone, and welcome. Today, we are going to unpack a massive, literally seismic shift happening right now in the global economy. For the past year, it honestly seemed like money would just endlessly pour into artificial intelligence. But suddenly, the tide has turned. It's turned in a way that has Wall Street completely panicking, and surprisingly, it could actually present a massive, hidden opportunity for markets halfway across the world.
$1.3 trillion. Just let that staggering number sink in for a second. That is roughly the entire GDP of Spain, wiped out from the US semiconductor industry in a single day. Yes, you heard that right, one single day. For an industry that literally seemed invincible, this is just a mind-boggling loss. And it perfectly sets up the central mystery of our explainer today. What exactly went wrong, and where does all that shifting capital go next?
Section 1. The $1.3 trillion shock.
Okay, so to really grasp this shock, we have to remember that up until this point, AI companies were basically on an unbroken winning streak. But reality just hit hard. This is the first major stress test for the global AI investment boom since 2023. And we're not talking about small startups bleeding out here. These are the absolute titans of the tech world. In just a single day, Micron dropped by 13%, Intel fell by 11%, and AMD took an 11% hit too. Even the tech-heavy NASDAQ index, which tracks all these major growth companies, tumbled by over 4% in one session. A 4% drop for an entire major index in a single day. That is an absolute earthquake.
And you can really see the sheer scale of this panic when you look at the absolute poster child of the AI revolution, Nvidia. Their stock dropped by 6%. Now, 6% might not sound incredibly catastrophic at first, but for a company of Nvidia's massive size, that equals $300 billion just vanishing into thin air in 24 hours. Just gone.
Section 2. Semiconductors, the AI engine.
Right, so to understand the crash, we first have to understand the boom. You see, semiconductors, they aren't just little pieces of metal and silicon. They are the foundational engine of our entire modern digital economy. Whether you're talking about smartphones, cloud computing, or AI, you simply cannot run them without semiconductors. The explosion of tools like ChatGPT required insane amounts of computing power, and tech giants went all in. Microsoft, Google, Amazon, and Meta started pouring hundreds of billions of dollars into AI infrastructure. We're talking massive data centers popping up everywhere across the globe, even in places like Andhra Pradesh in India. All of this created an explosive, almost insatiable demand for AI chips.
And because of all of this non-stop corporate spending, semiconductor companies hit unbelievable valuations. I mean, this constant flood of investment pushed Nvidia's valuation past the $5 trillion mark. To put that kind of hypergrowth into perspective, just before the COVID pandemic started, Nvidia's shares were trading around $4 to $5. Fast forward to the peak of the AI boom, and they had skyrocketed to over $200. It is literally the kind of growth that defines an entire generation.
Just take a look at the Philadelphia Semiconductor Index. It's basically the world's most important benchmark for the top 30 global chip companies. Back in 2022 and 2023, it sat pretty comfortably around 2,500 points. Then came this explosive 60 to 70% growth riding the AI wave into 2024. But then, as we saw, reality hit, resulting in a brutal 10% drop in just one day.
Section 3. Is the AI bubble bursting? So when $1.3 trillion just vanishes overnight, literally every investor starts asking the exact same question. Are we watching a global AI bubble burst? Well, here's the thing about bubbles. They don't usually come from fake products. They stem from genuine revolutionary innovations. Think about the invention of the railways, or electricity, or the internet. Because the tech is genuinely world-changing, people get incredibly hyped and invest massive amounts of money. But a bubble forms when those hyped expectations and extreme valuations outstrip the actual current revenue that the technology can generate. And right now, investors are seriously questioning if these AI companies can actually generate enough profit to justify their massive costs.
Honestly, a perfect comparison here is the dot-com bubble. From 1995 to 2000, there was this massive investment boom in anything even remotely related to the internet. Valuations absolutely exploded. Then, in 2000, reality hit, the crash happened, and companies vanished overnight. But, and this is absolutely crucial, did the internet disappear? No, of course not. It survived, it transformed the world, and it gave rise to titans like Amazon and Google. The exact same logic applies to AI. The short-term hype bubble might burst, and short-term investors are probably going to lose money, but the underlying AI technology is absolutely here to stay and will transform our long-term future.
Section 4. Why investors left India. So how exactly does all this create a global ripple effect? Well, for years, India was a massive favorite for foreign capital. Historically, India's technology strength was in IT services, outsourcing, and consulting, which are businesses heavily reliant on human labor. But investors completely panicked when they looked at AI's automation potential. Suddenly, a bank that previously needed 500 programmers might now only need 100 thanks to AI. 200 testers could be reduced to just 20, and whole support roles could be fully automated. And because of this massive fear of automation, investors got totally spooked. They pulled their money out, leading to severe valuation drops for major Indian IT companies. We literally saw giants like TCS and Infosys experience valuation drops of anywhere from 40% to 60% from their highs. Now, that money didn't just vanish. It fled to the AI hardware makers abroad. It went to places like the US tech sector, Taiwan, and South Korea.
But, okay, here is where the story gets super fascinating. If this whole AI hype is what originally pulled the money away from India, what happens when that hype hits a brick wall? Could a global AI crash actually end up benefiting India?
Section 5. India's Hidden Economic Advantage.
What looks like an absolute catastrophe for Wall Street could, paradoxically, be a massive, hidden economic advantage for India right now. Think about it. Consider an economy heavily dependent on AI valuations, places like the US tech sector or Taiwan. When reality hits and those AI revenues disappoint, investors in that economy suffer massive stock price crashes. But an economy like India? It's much more insulated from an AI bubble bursting, simply because its growth isn't tied exclusively to artificial intelligence.
Because India has a brilliantly diversified growth engine. Yes, of course, India uses AI across all its sectors, absolutely, but its actual stock market valuation is built on a rock-solid foundation of real-world, tangible growth. It's driven by huge population consumption, everyday people buying cars, homes, and consumer goods. It's driven by massive government infrastructure spending on highways and railways. It's supported by robust banking and financial services, and a huge push in manufacturing through Make in India and PLI schemes. So when disappointed global investors start looking for a safe haven away from overvalued AI stocks, this diversified fundamental growth starts looking incredibly attractive.
Which leaves us with one final, pretty provocative thought to chew on. As the dust finally settles on this $1.3 trillion shock, and the market gets a really harsh reality check on AI valuations, are we about to see a historic pivot? Will the disappointed global capital that left chasing an AI dream finally shift back into India's resilient, consumption-driven market? It is a massive shift in the global financial winds, and definitely something we need to keep a really close eye on. Thanks so much for joining me on this explainer, and remember to keep questioning the numbers behind the news.